in the late 60s, you had the market was very growth oriented. It was in like, Disney, Xerox, those types of companies. And they were very overvalued. And as they approached the inflationary 70s, you had higher discount rates that pretty much reduced the valuations of those big growth companies. And even though their fundamentals did fine, I mean, their earnings grew throughout the 70s. They got like a re-rating of their earnings multiple. And so the stocks went basically nowhere for 10, 15 years, even as their fundamentals continued to grow. And you basically had to get out that period of excess. And you had a market rotation. You basically, what did well was, energy stocks, value stocks, gold, things like that. The worst part was those like growth oriented, like basically a duration play, like a long duration asset, either treasury bonds or growth stocks are what did poorly.
Financial expert Lyn Alden provides a deep dive into the cyclical nature of markets, drawing parallels from historical trends to predict the future. She delves into the market dynamics of the late 60s and the inflationary 70s, explaining how growth-oriented companies faced stagnant stock values despite consistent fundamentals. Alden then shifts the focus to the 2000s, discussing the rise of commodities, including gold, and its impact on the market. She astutely compares the trajectories of assets like Bitcoin and gold, revealing surprising insights. As the conversation progresses, Alden emphasizes the importance of understanding global geopolitical challenges and inflationary pressures. Her analysis suggests a potential resurgence for gold as a significant investment choice, but she intriguingly hints at a broader strategy involving various commodities. To unravel this comprehensive approach and uncover the key to navigating the next decade in the market, you'll want to stick around until the end of this insightful discussion.
Similarly, when you had the crashing of the dot-com bubble, and then you had the next cycle, which was the 2000s decade. It was a very commodity value oriented decade. You had oil do really well, you had commodities do really well, you had a real estate bubble, banks, again, it was a bubble, but they were doing really good. Emerging markets were doing good, basically until that decade ended. And what happened with the stock market, the S&P 500, is they really only got roughly back to the dot-com bubble highs, right? So especially in inflation-adjusted terms, they were negative. And so you basically had another lost decade. And then, you didn't really reliably, after you had the crash of 2008, 2009, you didn't actually get back above the prior, dot-com bubble high in the S&P 500 until something like 2015. I forget the exact number and whether or not it's inflation adjusted. It depends on those details. But essentially, when you have that kind of growth to value rotation and that kind of disinflation to inflation rotation, it's usually quite poor for what the prior leaders in the market were. And it doesn't mean that their fundamentals collapse. It just means that their fundamentals chop along sideways to up, and their valuations kind of stagnate to take into account of the fact that the cost of capital is higher. Their inputs, either labor or commodities, are higher now, so their margins might not be as good. And so I do generally think that we're going to have 5+ years of not very good inflation-adjusted market performance, but that there could be some sectors, whether it's energy, whether it's infrastructure, certain healthcare, certain bank type things that were never really overvalued to begin with. I think you could have pockets where they do well. And if I'm right about emerging markets, at least the big ones, not getting crushed, I think you could have decent performance in some of those markets over the next 5+ years. But I would be concerned about these big U.S., large cap indices. I think looking back from the end of the decade, this will have been a good decade for commodities, including the precious metals. As far as, so it was, precious metals were generally flat throughout the 2010s. And like you said, we haven't really seen a bull market recently. One way to kind of look at that is if you look at Bitcoin, for example, we hit a high in 2017. And during this whole like FTX crash, for example, Bitcoin was sitting below the peak that it reached in late 2017. And so by some metrics, she went nowhere for 5 years, which was like half as long as gold went nowhere. Right, so it's actually pretty remarkable how that can happen, and it really comes down to choosing your starting points. So if you look at gold since the year 2000, last I checked, I haven't checked it in like a few months, but it's basically outperforming the S&P 500. Basically if you start from 2000, but of course if you start from 2011, it's done abysmally compared to the S&P 500, and that's in large part because you had such a massive bull market in the 2000s. which is, I mean, it's not as big as the 70s, but you went from like $300 gold to like $2,000 gold in about a decade. And you basically had a massive bubble. And so then it trended sideways from that point. And I had the basically the luck of actually experiencing that bull market because when I was a kid, I collected some gold and silver coins, starting in the 90s when they were super cheap. And I remember, it was like 2011, and there was like commercials for gold, how to like buy gold, and they were installing like gold vending machines. And I was lucky. I just kind of was like, this is like speculative. I'm getting out, so I actually sold my collection. And so I actually had firsthand experience of like seeing that bull market in action. So the fact that gold's gone nowhere for like a decade is in large part because of how insane the prior bull market was, and we kind of had to drain out all that excess. We are seeing, you know, even though Bitcoin's obviously, and some of the other cryptos are taking market share from gold and silver among retail investors, because there's more types of things you can buy now that you can self custody. Um, on the sovereign level, none of these things are big enough really to interest them. And so when you see, countries deciding where they're going to allocate their reserves, they are leaning more into gold, which is a big enough market for them to work in. And so I do think that during some of these problems that we're going to, if the things we discussed are directionally true, and we have an above average inflation decade, and it's a more multipolar world with more geopolitical challenges in it, I do think at the sovereign level, gold is interesting. And I think among certain percentage of the retail public, it's also interesting. And so I do think it's probably going to have a pretty good decade. But my approach is not to focus too much on any one commodity. And I generally have a view that most or all commodities are going to do quite well for the decade. And I want to have some degree of diversification into those commodities.
In the next segment, Lyn Alden shares invaluable insights on understanding market trends by exploring historical macro environments. Alden suggests a unique approach, examining the 1940s fiscal landscape as a cheat code for navigating the complexities of the 2020s. Drawing parallels between the past and present, she emphasizes that many current economic challenges have historical counterparts. By comprehending the strategies employed during high debt to GDP periods, investors can anticipate potential outcomes in today's market. Alden encourages viewers to view the 1940s as a baseline and analyze differences in the modern context. This method, she believes, offers a clearer perspective amid uncertainties, aiding investors in making informed decisions in this challenging decade.
My suggestion would be to become familiar with the 1940s macro environment, which I know is like oddly specific advice, but basically, I've generally found that to be like a cheat code for being less surprised in the 2020s. And I keep saying things like such and such is unprecedented, or such and such is like never happened. It's like almost every time I see that, I'm like, well, this happened in the 1940s. And it's basically the last time that the U.S., well, the developed world had very high debt to GDP. It's the last time we had major fiscal driven inflation. And the policies ended up being quite different than the 70s. The resolutions have ended up being quite different than the 70s. And while there's obviously not a perfect analog, I mean, technology is very different back then. A lot of things were different back then. But I generally find using that as a starting point and being familiar with it is basically like just a cheat code to reduce your level of surprise in this kind of environment. And then you start asking, instead of, okay, that's your baseline, and you say, okay, what's different now? What is not going to be like the 40s? And I think that's actually in some ways an easier question to answer than kind of just like looking at the 70s, or kind of looking at all these different times and trying to figure out what's going to happen. I think the studying that period is very useful for investors to try to at least help things be a little clearer as we kind of navigate this challenging decade.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.